let me try and recap what you've heard so far. So from the category presidents, you heard all about driving growth and the growth agenda in each category. Mark just talked about the supply chain. He talked a lot about the holistic gross margin program that 5S represents. We just covered it there actually, but I just wanted to reiterate that the targeted savings programs that we have are absolutely integral to our growth model and our margin development. Together with ZBB, we expect 6 billion euros in total between 2017 and 2019. We're going to drive growth with that money through reinvestment of about 4 billion of the 6 billion and margin up to our 2020 target of 20%. I hope that's really clear to everybody. That combination of growth and margin expansion, as I said earlier, creates an awful lot of value. And what I wanted to cover in this last session is how we're allocating resources across Unilever within our growth model to do three things. First of all, to evolve the portfolio. Secondly, to win across different channels following our consumers. And finally, to build capability and optimize our investment in what's a very fast-changing media landscape. And I'm going to burn a few charts in a second on that changing media landscape. I'm then going to show you how our model positions us for superior value creation through the financial targets on the right-hand side of this chart that you're already hopefully very familiar with. Before getting into resource allocation, though, let me just spend a moment to give you a brief update on the 5 big actions that came out of our 2020 program that we set out for you in April. First of all, simpler, faster organization. All of the CCBTs are in place and up and running. There's about 240 of them. And as Kevin and Amanda said, the integration of food and refreshment is very much on track. Secondly, the accelerated margin progress from those amplified savings programs that Mark just spoke about, really good progress. Savings, as Mark said, coming in faster than we expected. A lot of confidence behind our delivery there. Underlying operating margin, we think of at least 100 basis points in 2017, and that puts us very much on the flight path for that 2020 margin ambition of 20%. Accelerated portfolio evolution. Well, the pace and the velocity of our portfolio change through M&A has certainly increased. We, with the announcement of a couple of days ago, we will have completed or announced 10 acquisitions this year, and the exit from spreads by sale or demerger is fully on track. We're very happy so far with how that process is progressing. Simpler capital structure. You saw an announcement yesterday that the board review of capital structure is going extremely well. The acquisition of the preference shares, I think, is very important there to simplify our capital structure and, of course, to improve corporate governance. And I think Marijn will touch on that a little bit in his talk at dinner tonight. And finally, the increased leverage and returns to shareholders. The 5 billion share buyback is virtually complete, and the net debt to EBITDA ratio is well on its way to 2x by the year end. It might be a little bit short of that. It's mostly because of currency movements, etc., but well on the way with that. So good progress on the 2020 programs. Now, just turning back to this question of growth. Our model, as I said this morning or at lunchtime, is first and always a growth-driven model. We're fully focused on accelerating growth, no compromises, and our organization, frankly, understands that extremely well. In the context of that growth, we have been talking internally about this idea of 2 1% of growth. And let me explain what we mean in a little bit more detail by that. The first 1% is all about execution and leveraging those number 1 and number 2 positions of high market share through strong brands with purpose. We've consistently grown faster than our markets. There's various ways of expressing that. Absolute, bips of share gain is one. We also talk about percentage of the business winning share. But by and large, the one I prefer, particularly as more and more growth is shifting to channels which are not as well measured as our historical channels, is that we simply grow about 1% faster than the underlying rate of market growth. And we've consistently done that. Now, in the first 9 months of this year, as we said, Andrew and I at the Q3 results, we only grew in line with our markets. Now that happens from time to time, and it especially happens when you're going through a period of change in an organization such as Connected for Growth. But we are confident the actions we're taking will get us back to that position of outperforming our markets consistently by 1%. Why are we confident about that? Well, we're confident for two reasons. First of all, faster changing channels and faster changing trends put a premium on agility, and Connected for Growth is all about delivering that agility into Unilever. The second reason is that we're progressively stepping up our savings reinvestment through the second half of this year, and we'll reap the benefit of that, we think, in terms of a boost back to growth in the coming quarters. Turning to the second 1%, in parallel with Connected for Growth, we're developing the portfolio faster through M&A, as you know. We expect that the acquisitions and disposals we've done since 2015 will add 1% of ongoing growth momentum to the top line of the business from 2019. And together, both Connected for Growth and the accelerated portfolio change through M&A give us the confidence to reconfirm our guidance at between 3 and 5% of underlying sales growth between 2017 and 2020, with a step up of the volume component within that. Now, like all consumer companies, an enduring consumer packaged goods model starts with the consumer, and we've got 2.5 billion of them around the world, as I said earlier. 85% of those are in emerging markets, where clearly the demographics sit in our favor. Now, I know 2.5 billion seems like a big number, but the way I look at it is that there are 5 billion who aren't using our products every day, and that's where that growth opportunity really sits. And then add to that, there'll be another billion in the world by 2030 and another billion again by 2040, and you start to see why emerging markets and the geographic positioning of our portfolio has been something that all of the category presidents mentioned in their presentations earlier. But really, it's about focusing on the core of the business. We're very, very focused about the fundamental health of our core, driving greater penetration of our brands and leading market development there. That really has been at the very heart of Unilever's business since the very early days of the company. Market development in the core of our business is going to be at least as important in the future as it has been in the past, and it might even be that it's a little bit more important, because so much of the world's future consumer growth sits in those markets that are not yet fully developed. Our portfolio, our brands and geographies, our global local organization, and in fact our heritage, position us very well to reap the opportunities that those macro trends present across our categories, particularly in our emerging markets. And our emerging markets business overall is about a 30 billion business today. The growing belly of the population at middle income levels, we expect to see 600 million consumers move into that bracket by 2030. That, of course, drives up per capita consumption. Many, many examples I can give of that, but if we just take our deodorants business in Asia, where penetration is still below 50% across the whole of Asia for that category. Urbanization is a second big trend. We expect 900 million people to move into cities over that period, and that quite simply means more kitchens and more bathrooms to clean. And 200 million women will enter the workforce and move into paid employment for the first time in the same time period. That's more demand for products offering convenience, like cooking ingredients that save time in family meal preparation at busy times, etc. Now, we have proven models for market development in each of our categories, and there's a simple goal really behind that: more users, more usage, and more benefits. It's evolved over time, and the best insights in each of our businesses are codified in very, very repeatable models. Lifebuoy, which is shown here, is a prime example of market development over many decades. I think that's a young Mark Engel at the front of the queue there. And it pays off. It pays off for us. A nice, steady 5% growth year to date from Lifebuoy, just by focusing on the core, just by focusing on market development, which we've been doing for a long, long time. Now, a word about our organization. Since 2011, in 2011 we created one Unilever. And generally it's worked very, very well for us. The global categories set the strategy, and the allocated and managed innovation resources. The local operating teams across our 8 clusters executed that strategy, deploying the global innovations. And increasingly, as you know, we've been introducing more flexible business models into our organization, coexisting with the main matrix of categories and clusters. We run these differently, and we can because they address the needs of alternative channels and alternative segments. If you recall, we started talking about this over 2 years ago in the Philippines when Alan and, actually it was in Singapore, wasn't it? When Alan and Vasiliki gave a presentation on our prestige business at that point. Now, this one Unilever operating model has ensured great strategic consistency. It leverages our global scale really well, and it leverages our expertise on innovation, but it does restrict speed to address local opportunities, since decision rights on all innovation always sat with the global teams, and so therefore everything had to go up to the global team and everything had to come back down to the global team in order to act on it. And that's why back in early 2016 we started the Connected for Growth Change program, so 2 years ago. So C4G is, however, a lot more than just an organizational change. It's a very holistic program. It covers ways of working, it covers behaviors, and it covers the culture in the business. All of it with the aim, as it says here, of making Unilever faster, simpler, more global, and more local at the same time. Now, at its heart, there are 3 structural changes, which you see here on the left-hand side of the chart, also supported by a redesign of all of the functions in Unilever. It really has touched every single part of the company. The first of the structural changes is what we call the concept of 70-20-10. This means 70% of our global innovations landed at scale in the business. 20% of our innovations, broadly speaking, are implementing local trends on the global brand platforms, and 10% are fully local innovations. It means differentiated decision rights, resource allocation, and processes for the global 70, and a different approach for the local 30, if you like, which is the 20 and the 10. Now, it's important in all of that, of course, to avoid fragmentation and bringing non-value adding complexity into the business. And so the philosophy we have is that you have to do the 70% really well, flawlessly first. And after you've done that, with a lot of discipline, you have the freedom to work on the 30% in the business. You can respond then to unique local needs, which might become a future global trend, and we'll have the organization also to spot that now and let it accelerate up through the business more quickly. The second structural change are the country category business teams, or the CCBTs as we call it. These are cross-functional teams. They're responsible for delivery of the business results. They take innovations from the global teams and they land them in market, but they are now also empowered and resourced to develop those local innovations with speed, without the lengthy global approval process of going all the way up to global and all the way back down again. That's the 30 and the 70-30. With that freedom, as I said, comes responsibility, and to anchor that in, the CCBT leads report directly into the category or divisional organizations. This creates clarity, creates alignment in delivery of the global strategy first, and protects the scale benefits, and again, it protects against fragmentation and complexity, as I said earlier. Finally, the third part of the structural change is global brand communities. This is an extension of the global brand teams that we have. It involves all the marketers who are working on a brand. They're there to share and scale local insights. They're there to speed up the adoption of the global initiatives. I thought the example that Nitin gave earlier of Cif Duo from Italy, now going out to 15 countries, but starting locally as part of the 20, and then going out from there. That's the sort of thing that the organization allows us to do through, for example, the brand communities, anchoring everybody together on the Cif brand. The new organization, really, quite simply, it means we are more global and more local, as we said. with more frontline focus. We're very clear that more resources are placed out there in our markets on the front line of the business. There's a lot more empowerment. And we've got more resource and activity closer to the markets, which ultimately is where consumers live and where all the trends develop from. Now, we believe that the change with Connected for Growth really does position us to win in this fast-changing and competitive marketplace. We're progressively going to reap the full benefits of the change going forward, and reassuring where we're already seeing good examples of a more focused innovation funnel alongside greater local agility and speed. And I think we shared some of that with you on the last 2 or 3 results calls that we've done. To reiterate some of that, 70% of the innovations are globally led, benefit-led, rolled out to more markets faster than before. We've reduced the number of global innovation projects, and they're of a bigger average size. That allows more focused, better investment behind the winners. The 2 examples I like best are Magnum Pints and Baby Dove. They've been rolled out to 20 markets, both of those innovations, in just 12 months. At the same time, we're landing more innovation that addresses local needs. 30% of the initiatives are indeed locally led. Simpler, more flexible processes, as I described. But this bit is about being faster. We're trying to half the time to launch these things. The aim is less than 6 months, and Alan gave us an example in his presentation of Keiju in China, which was developed in just 6 months using exactly that process. We're also using, as Mark said, more third-party production, which again reduces the time to market, balances risk a little bit better, and is indeed more flexible, but it's above all faster. Examples here, Hijab Fresh, the new Muslim brand launch in Indonesia, which Alan covered. Knorr Fresh Meal Kits in Netherlands, which is on the right-hand side of one of Amanda's charts. You know, that's chilled food done through a licensing model with the online retailer Picnic in the Netherlands. And Nitin mentioned the premium Omo Naturals range in China. That was an exclusively online launch in Tmall in Q3. So there is a lot of confidence in the model that we've got. These CCBTs, as I said, are now fully operational. And most encouraging is the buy-in that we're getting and the reaction we're getting across the organization. We monitor this pretty closely with our people surveys. Now, there's always a risk of an echo chamber. You tell people we'll be faster, and it bounces back, we're being faster. But to guard against that, this is a sequential improvement chart. So this is the same set of questions asked in one quarter and re-asked in another quarter to try and take that echo chamber effect out of it. And it really does show the traction. It shows there's been a jump in speed and agility. It shows that people feel they're more able to focus on driving performance. And certainly people feel there's a lot more empowerment under Connected for Growth to really make decisions. Now, that was core growth and the first 1% and outperforming markets through organization and execution. I want now to turn to, alongside Connected for Growth and the innovation that that enables, the second 1% through developing our portfolio through M&A. Look, we are working a really clear strategy to position the portfolio for future trends and higher growth, getting to more consumer touch points in this fast-changing time. Each acquisition we've done has got a really strong fit to this strategy. For example, if you're on the page here, Carver Korea and Koala build on the strength that we have in PC, but they also fill in portfolio gaps, either a category portfolio gap or a geography portfolio gap. Dermalogica, Living Proof, and the other prestige businesses extend our personal care reach to higher price points with a very, very attractive growth profile at that price point. Sir Kensington's and Grom are examples of smaller premium brands that will indeed work very well as we take them through our mass channels. Blue Air and Dollar Shave Club take us into entirely new channels. Seventh Generation and Pucka are examples of meeting the growing demand for natural products. And as you know, since 2015, we've been a lot more active in this space. If you take the 19 acquisitions that we've either completed or announced since 2015, the consideration, as it says here on the right, was 8.6 billion. The acquired turnover, 2.2 billion. And together, all those 19 acquisitions grew 16% in the first 9 months of the year. That's not at all in our underlying sales growth number, but it will feed in. So I'm talking here about the impact from 15 before we did any of these deals to 19 or back end of 19 by the time we've had them all anniversaried and into our underlying numbers. Of course, alongside that, we also dispose brands that no longer fit the long-term strategy, typically somewhat lower growth brands. And the combined impact of all of that since 2015, as it says here, adds 1% to the ongoing growth of Unilever. Now, that doesn't include the latest acquisition, Sundial Brands, which we announced 2 days ago. You heard Alan talk about it earlier, and we're going to have the founder and CEO, Richelieu Dennis, on the panel tomorrow, and that's going to be a really good opportunity, I think, for you to meet him and, you know, when it's really fresh, talk about what it's been like to become a part of Unilever and what it was like to the philosophy behind a founder like Rich, you know, coming into the Unilever family. I think it's going to be a great opportunity. This is just an example of evolving the portfolio through innovation and M&A, focusing in on naturals. Why is it significant, naturals? Well, Amanda showed an incredible lineup of Knorr innovations in the natural space on one of her charts earlier. And as Alan said, in personal care, the natural space, I think I get it right, it's growing at 2 times the rate of the personal care market generally. So very, very strategic significance on naturals. We're getting there, as this chart shows, through both innovation and through acquisition. There's just one example here for naturals about how we've shifted through many routes, global and local innovation, and through acquisition, significantly upped our game in naturals over just the last 12 months on one chart. I'd like to move now, though, from portfolio and onto channels and shift gears a little bit. I want to look at what's also changing through the lens of our channel footprint. Because it's not only the consumer shift in product choices, but it's also a shift in how consumers are shopping. It's really important that we have the right portfolio and the right channel strategy in order to win. First of all, you know, there's a bit of a myth that consumer will move completely out of big box retail and the entire basket will shift to e-commerce or experience platforms. Of course, there's going to be less reliance on a single weekly shop, and there already is. But supermarkets, as you can see here, will still be our largest channel for many years to come. Now, within that channel, we've called it out here, there are areas of very strong growth and shopper appeal, you know, the discount channel and convenience stores, for examples. This has implications for our innovation range, for our product design, etc. And of course, it gives us a little bit more cross-channel conflict to manage as more consumers shop across those channels. So it's a challenge and it's an opportunity for us. We also, in the green bubble, you can see that we expect to see continued strong growth of traditional trade in the emerging markets. That's going to be driven by those big macro trends that I touched on earlier. And frankly, that's a demographic force that just isn't going to change, and frankly, a really key defining strength and capability of Unilever. And you can see that traditional trade remains up to 1/4 of our business, we think, looking forward for the next 5 years. What is changing, of course, in both the developed markets and in the emerging markets is that consumers are shopping much more frequently across more channels. And this idea of an increasingly differentiated shopper mission means that each channel needs to be more focused than ever on meeting a specific consumer need. And you see here, over the next 5 years, we expect around 30% of our turnover, that's the 20% sum of the green dots and the last 10%, to come in what we've called experience platforms and e-commerce. And that's about a doubling. It's about 15% today, but we expect that to double. It's 15% in 2012. We expect that to double over the course of the next 5 years. Channel shift brings a lot of disruption, but we see many opportunities, as you can see on the chart, from the growing channels on the bottom half. The things it allows us to do, take health and beauty as a channel. Well, that's a fantastic opportunity for product education and trial. If you take brand stores, a particular type of experience platform, that gives you direct access to consumers. It gives you a fantastic performance space for your brand. The idea that nothing's gone physical, I think is absolutely a myth. You need to be able to have a physical presence and a physical performance space for your brand. You build equity in these stores by experience, not necessarily by investing in media. And e-commerce, of course, gives you many, many new distribution points and allows much, much more focused targeting of the consumer. Against that, we think we're very well placed in this channel landscape today and in the future. We're going to build and reinforce the current strengths that we've got through our channel strategies, as you see here. First of all, in supermarkets, we're going to protect the value that we have. This means really strong joint business plans. It means deep, deep category expertise that we can bring to our retailer partners in order to do the old thing of driving category value. I think the very best example, as I see it dotted around some of the tables, is dry spray deodorant right here in North America. Tremendous uplift in overall category value, a win for the consumer, a win for us, and a win for our retailers. And the other skill, of course, that's going to be very important there is net revenue management. In the traditional trade, the green dot there, we're going to leverage technology as we are today, but really accelerate that across our sales force and our distributor partners. This is, you've heard me talk about this before, this is leverage, this is Darwin, this is fusion, this is the projects we have using technology that come out of India and Brazil, but of course we take it then to Indonesia, to Vietnam, to the Philippines, to Pakistan, to Nigeria, to all those places that Nitin explained earlier are where the growth really sits for Unilever. And that, of course, allows us to really work with our small store holders and our distributors to optimize range planning and replenishment, and also harness information that we play back to them in order that they can run a better store, they can get more throughput, not just of our products, of everyone's products, but of course the fact that we implement the technology and reinforce that strong relationship gives us a long-lasting advantage. We're also going to invest in new capabilities, like the experience platforms, which are the yellow bubble here. We expect, as you can see here, that to grow maybe 50% faster than the rest is our estimate. This is things like food solutions, our B2B food service business, digitalizing that for an even better connection and giving real utility and service to our community of professional chefs who sit absolutely at the core of that particular platform within our business. It also means in health and beauty, where historically we've under-indexed, and as Alan said, we expect by 2021 this will be 20% of personal care through this particular channel. We need to rework aspects of our channel model there, from portfolio to our go-to-market approach, and we'll be looking to drive double-digit growth in that channel going forward. And of course we expect that e-commerce in the lighter blue dot, we think that'll contribute perhaps 40% of our total growth. We're continuing to invest to build capability there across many different models. Maybe it's grocery.com, pure play, direct to consumer, etc. But we're really confident whatever e-commerce model develops fastest, we will have the capability to grow ahead of our markets, as today we do in e-commerce in the US, for example. This more differentiated channel strategy is really paying off. Investment in broad e-commerce expertise is driving a 40% growth rate for e-commerce. It also allows us to have higher online gross margins and higher online market shares versus offline. E-commerce is now 3% of Unilever. We expect it to be closer to 4% by the end of Q4. We have the #1 out-of-home ice cream business globally, as Kevin's chart showed, by quite some margin. There we'll be leveraging to drive growth for early activation and season extension. The innovative and expert mindset in that food service business, Unilever Food Solutions, has driven USG of 5% and more than half of that from volume, and the launch of the 2 brand new health and beauty brands this year that Alan mentioned, Love Beauty and Planet and Apothecare, that allows us to build scale in a very, very attractive channel, both organically and inorganically. We've got a nice balance between the acquisitions we're doing, but also, very importantly, developing our own brands with different models which are specific to certain channels. Now, Connected for Growth brings our customer teams much closer to our marketing teams, and I want to share some specific examples for you of where we are, as a result, producing more innovations that are specific for particular channels. In health and beauty, we've extended Dove into face care. Alan showed Apothecare, Love Beauty and Planet. That builds scale really fast in a fast-growing channel. In direct-to-consumer, we're building capability with quite innovative business models of Dollar Shave Club and T2 in tea. In wider e-commerce, we launched Keju by Lux in China, as Alan said, co-created really with a Korean designer to get on top of the very exciting K-beauty trend with urban millennials. And in the UK, we've launched 4 Amazon laundry bundles, really understanding the algorithm there to win in search and allow us to tailor our product offering. In the discounters, where the price point matters most, we're producing a lot of discounter-specific packs, lower retail sales price, maintaining the gross margin. The example in the bottom right there is Sure in the UK, produced at a £1 price point. And to do that, we've had to reduce some of the premium technology in the packaging, and we've reduced a little bit of the artwork complexity that we would normally have. That's how you get to a £1 price point and make sure your margin remains nice and healthy. And that was channel. And let me go back to the consumer and specifically the communications and media landscape. There's no doubt consumer journeys have become more complex and more digital. It's technology, and it's especially mobile, that fundamentally changes how consumers interact with brands. We're all consuming more media on more devices than we ever did before. We're increasingly able to choose the content that we think is most relevant to us. We're able to create our own content, and we're even able to curate the content of other people's. A combination of this fragmenting media landscape and the changing channel landscape completely rewires consumer paths to purchase. They used to be linear. They're now no longer linear at all. They are more sophisticated. There's multiple touch points along the way, and yet sometimes only one click from a consumer will take them from a journey of discovery to a purchase. Now, our journey as consumers may or may not involve a trip to a store anymore, but it often starts with search. In fact, it most often starts with search as the point of entry. And there can be a complex research process that uses multiple devices before we make that purchasing decision. We know that reviews and opinions from social communities play a really large part in our decision as consumers. And we increasingly see word of mouth and online reviews as the greatest influencers of purchasing decisions. This consumer journey now leaves a very data-rich trail for us, a sort of primordial soup of data that is out there now for us to go and play in. And that's littered with lots and lots of relevant moments where a brand can engage with a consumer. It's understanding this trail and acting well in it that's going to unlock huge opportunity for this business to be more targeted, to be more personal with our brand communication than we ever have been before. So how do we win in this new consumer order? The quality of our advertising content and reach, despite the fact that consumer journeys are now more digital and more complex, the quality of the content and reach will remain the two biggest drivers of return on investment. So we target broad penetration, and we plan multi-screen, multimedia now to deliver three things. We look to deliver reach, we look to deliver impact, and we look to deliver relevance. In the last 5 years, advertising spend has shifted. Digital media spend, as you can see here, in Unilever has gone up by 130%. The cost of creating digital assets, what we invest creating digital assets, has gone up by 60%. Traditional media spend is down slightly in absolute, while efficiency in traditional asset creation means that we're 35% lower investment in asset creation in traditional. Overall, when you package it all together, digital, what you might call digital advertising, I hope we don't call it that anymore, but if you might call it that, that's now about 1/3 of our spend. Now, zero-based budgeting, oops, has it dropped off? Hang on, there we go. Zero-based budgeting quite accurately allowed us to identify where we sat on the relevant benchmarks. And we made a deliberate choice to protect the viability and momentum of our growth model for the long term. We targeted substantial cost reductions in asset creation, but we continue to build our equities through strong media investments, showing fewer assets to more communications for longer, which I think you agree is just common sense. You see the impact of that in the 130 and the 60 and the 10 and 35. You can see that we've been, spending more on media, less on creation. So fewer assets, more consumers for longer. As we've adjusted the way we plan media to reach consumers at relevant touch points in this new consumer journey, you can see here that it's not really about traditional or digital. As I said, I really hope that we can shift our conversations away from that question of traditional or digital. It is about multi-screen media planning. I want to dig into this just a little bit. 5 years ago, the idea of digital was very relevant. There was a clear distinction between offline and online media. In that environment, we spent around 15% of our spend on digital and about 85% on traditional. And we considered that pretty optimal to maximize reach because, again, we were looking at reach as the key thing that we're after. Now that that online and offline distinction has blurred, we see less relevance in that traditional versus digital distinction. The most effective media channel can vary between category, geography, and indeed the objective of a campaign. And we found that to optimize reach, we need a holistic approach that amplifies messages across multiple media channels. And there's a widely different ROI against all of them. For example, winning in search is increasingly crucial, capturing that consumer attention at the start of the research journey. TV or video, though, is still one of the very best ways to cut through, but it's relatively expensive to create, as we know. Good social posts, which are perhaps the hardest things to create, but if you do them right, they can have some of the most attractive returns. And good display helps very well to close a sale at that point of purchase. The output of optimizing all of these divergent ROIs is that 1/3 of our media spend digital that I mentioned earlier. By conventional definitions, you would say that was digital. However, it's not at all a choice explicitly going in to say, is it traditional or is it digital? It's an outcome of maximizing reach in the most efficient and the most effective way. We've seen a lot of change in the last 5 years. We expect to see even more in the next 5 years. This is an estimated roll forward. Now, nobody has got a crystal ball here. This is market data, incidentally, but the Unilever picture that we expect wouldn't be too different to this. But please take a pinch of salt with this. Don't get rulers out and try and think about how things are going to shift, etc. One thing seems really, really clear, though, and that's that the degree of online and offline integration is only going to increase even further. Now, some people might predict that people will be talking less about TV, but there's no doubt that people will still consume a lot of video content on some form of screen, whether that's a big screen or a small screen. Frankly, the human, love affair with watching moving pictures in a rectangle is happily going to continue for a long time. But no matter how much that media landscape changes, it's ROI that's still going to drive our media allocation, and we're always going to seek to optimize the reach of our content across multiple platforms, whatever those platforms happen to be. And that's why the Connected World program, which our marketing function is running alongside Connected for Growth and having one marketing organization focused on Connected World, is so important. It frankly equips our marketeers with the right skill set and the right insets to make the right choices in today and tomorrow's advertising world. We're investing in some world-class capabilities in this space. 3 examples here. Data capability at scale with our people data centers, which Stan will show to you tomorrow. This gives us real-time insight in 20 markets with 25 people data centers. It really deepens our consumer understanding. We're seeking to build 1 billion richer one-to-one relationships with our consumers. I want to put some emphasis on relationships there. We're not just trying to pick up an email address or a data record. We're trying to build 1 billion relationships. We're reinventing consumer engagement through an in-house content capability that we've built with U Studios. This allows us to create content in a more agile, personalized, and efficient way. We've got it now in 17 markets. And so far we've run over 3,000 projects through U-Studios across 200 brands. And finally, we're continuing to leverage efficiency and effectiveness in our media buying with Ultra. And Ultra, frankly, was very pioneering. It's our proprietary programmatic trading desk. Simply put, it allows us to reach the right people with the right context at the best price. So in summary, it all boils down really to three things. It's about better insights generated earlier. It's about relevant content created faster. And it's about effective and efficient media planning and buying. The last part of this presentation, I want to try and pull it together for you a little bit and answer the question, how does Connected for Growth strengthen our growth model? And how does this translate into superior value creation? So, as I hope we've shown over the course of this afternoon's presentations, our Connected for Growth program goes way beyond organizational change. It is really a comprehensive set of linked changes that transforms Unilever into a stronger, more agile and more successful business. On-trend innovation, more global and more local, remains fundamental to growing the core of our business. And so too are extending our emerging markets footprint and driving continuous market development in that core. At the same time, as I said, we're evolving the portfolio to capture the emerging segments of the future. We're doing this both organically and we're doing it through M&A. Acquisitions can be a faster route to tap into the growth opportunities, and we're more frequently running those acquired businesses with flexible models outside our main organization. And we're also working very hard to develop channels, e-commerce of course, but also out-of-home, food service, brand stores, and health and beauty stores. Now, underpinning these three pillars are our targeted savings programs, providing the fuel for both growth and for margin expansion. And integral to the whole lot is the Unilever Sustainable Living Plan. That's, as you know, not just an additional bolt-on to our strategy, but it really is sitting at the heart of our strategy. It helps drive sustainable long-term value creation. We're very, very clear about that. It drives higher growth for purpose-led brands. It drives lower costs through savings in packaging, energy and waste. It drives higher trust in Unilever and our brands, very relevant for millennial consumers who are going to be an increasing proportion of our consumer base. It gives us continued access as well to world-class talent, and it reduces risk in our supply chains. Now, our savings programs provide the fuel for growth and margin. I want to give you a very quick summary of progress on them. You've heard a lot about it already, actually, but the step up in the rate of saving comes basically from three key programs. First of all, 5S, which Mark described. We're rolling that out across the whole of the business. It brings marketing and R&D in particular in more often together to deliver really sustainable gains in product margin. Zero-based budgeting. We're really making activity system improvements and better choices across brand and marketing investment and in overheads. We're well into implementation. As Mark said, one of the reasons for the step up in our margin ambition was the line of sight and the confidence we had in how zero-based budgeting, or our form of zero-based budgeting, was landing in Unilever. It's already locked into our 2018 targets and plans. We have really, really clear what we call operational KPIs for zero-based budgeting. That's not to track delivery of the savings. We don't set savings targets for ZBB. We set operational KPI targets. And that ensures that we're delivering the underlying operating improvements that are consistent with growth, with the savings and reinvestment of the savings as an outcome of making the operational improvements. And the final driver is the organizational changes under Connected for Growth. We have a 15% reduction in middle and senior management levels outside of customer development. And combining food and refreshment into a single legal division based in the Netherlands, as Amanda and Kevin said, we would aim to reduce the overheads of that division by about 20%. In total, that's going to give us that 6 billion of savings in the 3 years to 2019. 4 billion in supply chain savings, 2 billion across BMI and overheads. Just to say again, 2/3 of those savings will be reinvested behind competitive growth, 1/3 taken to the bottom line to grow our margins. Those savings programs really do give us the headroom for portfolio change. And this is why the savings are so strategically important to us. In 2016, we did a 19% return on invested capital, which includes all of our acquired goodwill. Now, growing a business with already such a high level of ROIC, of course, very value creating. Once you've got a high ROIC, your objective should be to grow the business. And delivering the 2020 margin targets, of course, accelerates our ROIC even further. We're very, very clear about our value creation model. Reinvesting to accelerate growth and compound the returns on investment, reshaping the portfolio towards faster growing segments and channels. Doing that through a faster rate of M&A brings more goodwill onto our balance sheet with a diluting effect on ROIC in the initial years after a transaction. And that offsets the ROIC accretion from the growth and margin expansion. That's a very, very conscious choice that we've made. We're very clear that growing our business faster for longer is going to create more absolute value than maximizing the ROIC in the short term. Taking both those drivers together, the growth and margin on one side, the goodwill from the portfolio change on the other, we still expect to be able to sustain a high teens ROIC, and that in fact has been embedded now in our long-term incentive targets. Just to finish up, let me just cover off what I stated at the start today. We've got a strong portfolio of brands, we've got unparalleled geographical presence, we've got true strength and breadth in our distribution, and we've got diversity and deep experience in our talent. The things that guide our resource allocation are our differentiated category strategies, and that allows us to drive USG ahead of the markets 3 to 5%. It'll let us get to a 20% underlying operating margin by 2020. And it'll allow, as Mark said, to get us to 100% conversion of net profit into free cash flow, up from about 85% in 2016. That rolls into EPS growth. It rolls into high returns on invested capital, strong free cash flow, and hence shareholder returns. And that's the simple framework that we've now built pretty deeply into the short-term and long-term incentive plans for all of the people who work for you here in Unilever. And I hope that's clear and well understood. And with that, take a couple of questions. 5 minutes of questions. Nope, not 5 questions. 5 minutes. Good. Hi. We have mics. So I'm going to go over here first. Thanks. Oh, go ahead. You take it and we'll come back to you.
Thank you. It's Mitch Collett from Goldman. You talked about how Connected for Growth should be able to help you deliver better volume growth. This time last year, I think Paul said he wanted a better mix between volume growth and price mix. Maybe could you talk about why volume growth hasn't really improved? I know he said at the time we shouldn't look at it on a quarter-by-quarter basis, but given that input costs have been fairly favourable, why haven't you had better volume growth? And then secondly, just a point of clarification on the contribution of acquisitions. You've got 2.2 billion of sales growing 16%. By my maths, that's about 70 basis points of growth acceleration. Is that rounding? Are you expecting those acquisitions growth rates to accelerate? Or is there more acquisitions to come that will get you to the 100 basis points you've talked about?
All right, thanks, Mitch. I'll take the second one first because your math might be about right, but there's 40 basis points or so that's the exit of spreads, which is the delta between the two that gets you to the 100 basis points or so. So it's a combination of the acquisitions and the disposals.
And actually, maybe, sorry, on that, you said most of it isn't in the growth rate you're doing at the moment. So how much is baked into the 2.8% you're doing in the year to date?
And virtually none. Virtually none of it. I mean, we close the transaction 12 months later, it rolls into our underlying sales growth measure. So the 2.8 takes at least 12 months. I mean, just to be really clear, that 1% we expect to see during the course of 2019. At some point, the benefit of the transactions we've done, the 19 transactions so far, will benefit into our numbers from some point during 2019. On the question of volume, let's talk about emerging market volume because, we've talked a fair bit, all the presentations today about our strength in EMs. And if you go back over the last 30 years or so, you'll see that, if you take out all of the price growth that Unilever's had in emerging markets and you just say that is all eventually washed through by devaluation of currencies. It isn't really, by the way, but let's just simplify it and settle there. You have about a 5% CAGR of growth for, Andrea, is it wrong, 25 years, something like that, of 5% growth. Now that hasn't happened, Mitch, for the last for the last 3 or 4 years, we've been around 1 to 2% of growth. I thought it was quite encouraging in Q3 that emerging markets got, I think we were over 6% growth in the EMs, and we were 1.8% of volume growth. And as Alan said, I mean, he saw encouraging trends within the volume, albeit in a rather low personal care number. So there's a question here around emerging market recovery, the cyclicality of that. I think it's very cyclical. I think you go back to the demographics, you go back to the fundamentals of people entering that sort of middle income class, you go back to the trend of urbanization, you go back to the basic growth rate, and we will see volume growth returning there. What we've had specifically over the course of the last 3 months, just of the year to date, 3 of our biggest markets with a big presence, Indonesia, Brazil, and to some extent India with the changes fiscally taking place there. That has hit volumes, and as Alan said in his presentation, it's hit personal care in particular because we have a very, very big personal care portfolio there. But we're confident the volumes will be back. I think it's less a question of the interaction with commodity cycles and pricing. I think there's some more fundamentals in there. If you take Brazil, for example, volumes are -5 in Brazil. We have a very big business there. Volumes in Indonesia, a very big business there, were -10 in the second quarter. So 1 or 2 specific emerging market hits. But to answer your point, really, I mean, it is about emerging markets, and when does emerging markets get back? If not to 5, then perhaps to 3, perhaps to 4. But whatever happens, that's a superior level of growth if you've got our sort of footprint. Yeah. Hi.
It's a question on M&A, which partly for you, partly for Alan. The last 2 of the more recent deals, especially in personal care, have been from private equity, who've actually got in very recently, in the last 1 to 2 years. Is there anything within the organisation you can do to change to mean you get there first?
It's a great question, and in fact, I had quite a bit of discussion about this during the coffee breaks. In theory, you'd love to get there first, but in reality, a business like this, a scale business like this, will find it very hard, I think, to pick a winner. And it's important to note that for all of the businesses that we look at, as Alan said, we look at way more businesses than we actually end up acquiring. There are 2 defining things to them, I think. First of all, in the case of some businesses, take Dollar Shave Club as an example, they were far and away from the first people to offer an online subscription shaver business, razor business on the internet. And they were far from first, and there were many, many companies that tried and failed to do it. So I think for a business like this, our ability to spot the winner and allow that to be proven and then step in, offering the scale opportunity to the founder of the business is what the founders find attractive and what's making us, I think, pretty successful so far in increasing the velocity of M&A and using M&A to shift our portfolio strategically. The second thing is that it would be easy to think of these businesses, founder businesses, as new businesses, as startup businesses. Most of them aren't. Most of these businesses have been going for 20 years, 10, 15, 20 years. So it takes a long time. And what you typically find is that the business has evolved over a period of time. It's gotten up to maybe 50 million of turnover, maybe 100 million of turnover. At that point, 1 or 2 private equity companies will come in. They'll I think, to be honest, secure financially the good work and the incredible brand and purpose and positioning that the founders have created that takes a little bit of risk out of the system for them personally, and then actually helps them to scale up further to perhaps 150 million, 200 million. At that point, founder reaches a problem where you say, look, I'm really in business here to take my business out. I mean, they're very, very purpose-driven businesses, and the founders want to get the business out there and scale with it. And at that point, they see an opportunity in partnering with Unilever to do that, to take it to the next level. That's what we've tended to see in those businesses. But by all means, great question for the founder panel tomorrow.
Or the model is unproven. But the 2 I was referring to in particular, I guess, are Carver and Sundial, both of which private equity got in within 1 and 2 years before you, both of which you said have been around for 20 years, and you both bought actually from the same private equity.
Yeah, I think that's pure coincidence. I think you better ask them how they've managed to be so successful with their model. I don't care. You shouldn't care either. I don't think it is a fact that they come in and they help those founders and they create those businesses. Our business model doesn't say, well, hang on, how much is somebody making who's only been in for a 2, 3, 4, 5-year period. We look at what we can bring to the business. We're very clear, we're very rigorous. Nothing has changed in the way in which we think about M&A and value creation in M&A. Nothing has changed at all on that, and we only look forwards. We don't look back about who may have made what money. Rest assured, we're not in the private equity business, so and plenty of private equity firms are successful and plenty are less successful. Thanks. Warren, hi. Oh, not you, Warren.
I'll just grab the mic. It's Eddie Hargreaves here from Investec. Just to follow on from that sort of line of discussion, how do you incentivize the founders who you retain in the business typically?
Well, the first way is first thing to say perhaps is that the discussions, of course, there's a discussion about valuation. Of course, there's a discussion about structure. With many of these businesses, the involvement and vision of the founders is of particular value to us. The reason we run them in a separate, more flexible model is to retain the spirit, the brand essence, if you like, and the passion of the business. And therefore, usually, we're in a situation where we are trying to work together with the founders to come up with a model that works for them and works for us. By far and away, though, the biggest piece of the incentive must be the purchase price. Obviously, that takes care of itself. In many of these deals, there's a form of back-end incentive. In some cases, and you can talk about this in the founder panel tomorrow, we will set up perhaps a social mission board. In the case of many of the companies, they're B corporations already. We will maintain them as B corporations. That's nothing new to us. Ben & Jerry's is a B corporation. It's been in Unilever for 17 odd years. So we've learned a lot from that, and we've actually been able, I think, to scale it. We've been able to use our experience and use the founders who've joined Unilever and had a good experience, including Ben & Jerry, to engage with companies that we're having a dialogue with and get them to represent what it's like joining Unilever. In some respects, possibly one of the toughest things we have to do is to sell Unilever to these founder businesses, because they're very strong businesses and they've been very successful typically, and therefore the idea of why is Unilever the right owner of the business and partner for the next phase is the question that we come across. Warren? I think this is the last question. I'm getting Andrew waving at me.
Graeme, two questions. First one's on share buybacks. You've said, I think, that you've almost done the 5 billion buyback, and on my numbers, I think you're still below the 2 times net debt EBITDA. Is there any expectation that there could be a share buyback in 2018? And related, if you do sell spreads and it's diluted, would you consider a share buyback to offset dilution? And the second one is completely unrelated. It's actually on Amazon. What is Unilever's strategy with regards to Amazon, and specifically in the area of voice search, with everybody owning Alexas for Christmas? Is there a risk longer term that brands actually start to get disintermediated, and what's your strategy in voice?
Well, I'll take the second one first. On that, you're going to hear quite a lot. I'm going to steal Luis and Stan's thunder for tomorrow, but you can ask them that and hear a lot about it. Suffice to say, voice is hugely exciting. I think it will be a big disruption in the way in which brands interact with consumers and the way in which consumers shop over the longer term. It's one of the technologies that I think is going to be, as the home and your car becomes more connected, it becomes more natural to have a dialogue about how you want your shopping basket to look. It allows personalization, etc. So all the things we talk about in the connected world, I think it does get quite sharply focused in the area of voice. We've got some terrific partnerships running with Amazon right now on Alexa, for example, and we think we've got we're pretty much at the leading edge in terms of the dialogue and investigating how our brands can play in that space. But by all means, let's pick that up with the guys tomorrow. What was your first question? Oh, share buybacks. Look, really what we are being guided by is that 2x leverage level. And it'll be a little bit of a shock absorber. Sometimes we'll be under it, sometimes we'll be above it. But when that happens, we'll look at all forms of dealing with that. We would hope, because of our high ROIC and because of our growth model and the fact that we think we're better investing in the business for a higher return, we'll try and continue to find ways of investing in the business of Unilever in order to sustain the returns and accelerate our growth. That would be our preference. But if we don't get there, then yeah, we will look at returning capital to shareholders to swing and equilibrate around that 2x level. I don't think we can be too specific or pernickety about it. If it ends up drifting a little bit higher, then we have that discussion. If it gets a little bit lower, then it probably means we've been pretty active in being able to change the portfolio a little bit faster. So obviously we'd like it to be to be higher rather than lower, to be honest, and that would indicate that we're investing more within the business where we think we can generate a higher return. But definitely that's how we would have that philosophy, and that applies to the spreads divestment as well.